The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners have been having a profitable week since our last episode. I am joined, as usual, by my partner in crime, my virtual soulmate, if you will, Don Schlesinger. Don, how are you doing today?
Just fine, Mark. Always a pleasure to be here.
Like I said, I'm still missing that Boca courtside episode. That was fantastic. We need to record in tropical locales more often.
Well, we dodged another bullet with a prediction in my neck of the woods for 1 to 3 inches of snow this morning, but it never quite materialized. We're still waiting for springtime, though.
My God, you'd think you were up in North Dakota or something like that with the amount of snow you keep talking about. Every time you're on the show, you're talking about snow.
It's been some sort of a record-breaking winter, and again, even though we're into spring, it certainly doesn't feel like it.
Yeah, we're having the same fun here in Chicago. No snow, obviously, but a nice little cold snap to remind you that winter hasn't left us for good yet. Usually in Chicago, once St. Patty's Day rolls around, that's kind of the official demarcation of the beginning of spring.
The weather likes to give you one good swift kick in the pants in the middle of end of March, early April, just to remind you that it's not going to be really, really nice for 2 months.
And our eagle-eared listeners who tune into the Options Insider Radio Network on a regular basis will recognize that tinny voice. It is none other than the greasy meatball himself, Mark Sebastian, from OptionPit.com, as well as many other ventures, including managing the mini metals on a regular basis on their road tour. Mark, welcome to Volatility Views.
I'm excited to be here. This is I feel honored to be a part of on this special panel of volatility experts.
If we keep this up, I'm going to have a regular slot for you on the Options Insider Radio Network going forward.
I know. I need to send you a headshot so that you can add me to your list.
The second chair. That way I can take a nice vacation and you could fill in and do some
I'm the Jobo to your Eddie.
I'm not sure if that's good or bad, but that might be interesting.
You don't remember Eddie and Jobo, do you?
I do not know.
So as long as I'm not the Baba Booey to your Howard Stern, I'm okay with it.
There we go. I like that analogy is a little bit better.
Who would that make Don, what's her face?
Yeah, he'd be what's the woman's, Robin.
Yeah, does that make Don Robin Swivers?
All right. And with that out of the way, we will roll right into the Volatility Review.
It's time for the Volatility Review.
And welcome to the Volatility Review. In case you can't figure it out from the name, this is where we sit back and review the activity that's been going on across the spectrum of volatility during the past week. And there's a number of different places to look at and to start off with when we're talking about volatility. Obviously, a lot of people come to vol, and the first thing they think of is VIX, and the VIX cash has had yet another down week. Of course, it started off earlier in the week, about 1944 close in the VIX cash, and earlier today, it was hovering around 1678, so down nearly 14%. And of course, the VIX cash, dubious measure that it is, and there's a lot of other factors at play today. The market is rallying, the weekend is being taken out, so that will of course compound the crushing that we're seeing in the VIX cash. But Mark, we brought you on the show today to be our roving volatility reporter, our pit reporter, term you are very familiar with over at OptionPit.com. So why don't I let you dive in here a little bit and discuss what you've been seeing from your pit reporter point of view?
Well, it was interesting. I think we talked about this on Option Block yesterday. The S&P 500 13-quarter straddle went out, weekly, one-day expiration straddle went out for almost exactly $10. Right now, stands after the after the announcement this morning, the S&Ps are trading 13.36. So you would have made $1 on your straddle. So
a whole $1. There we go.
I know. So the interesting thing is that VIX is down significantly. I do think a lot of it's from the weekend because we're actually moving a little bit today. I mean, if you look, all we've really done, a lot of this has been up the skew curve. So that's one of the issues when you're using kind of a floating at the money measure of implied volatility. You're kind of subject to movement up the skew curve and, of course, the weekend. I think if you adjust out the weekend, I only have the VIX down about 0.3 to 0.4% today. So that's kind of what I'm looking at. So what are you seeing today, Mark?
We discussed a little bit about that last week, Don, if you recall. The differences when looking at these numbers, what you can pull out from just traveling up the skew curve. Like we said, the S&P's up almost 11 handles, Dow's up nearly 90 points. So there is a lot of that just coming up from the old sliding up the curve, as you will. We discussed that a little bit last week. And then, of course, there's also what we discussed to a great extent yesterday, and we can maybe conclude our discussion here today regarding the old SIBO skew index. And how fun and relevant this one is. And Don, maybe you can chime in on this for us, actually, to settle a discussion we were having yesterday. We were discussing the relative merits of a skew index and what you really need something like that for, and the obtuse way that it seems to have been put out with the numbers between 115 and 150. And Mark was suggesting an alternate version that would use the OEX instead. And we got into a little bit of a discussion regarding what the impact of the old 1.5 would be on that and the correlation between the OEX, using the OEX and trying to pull OEX vol and OEX skew and comparing it to the SPX skew and the SPX vol. So obviously you're just jumping into this conversation late, but what's your opinion on doing something like that?
What was the overall justification or the rationale for preferring one to the other in terms of what might be a superior index?
Well, the issue is that if you're trying to take skew and mesh it with the VIX, it doesn't work very well because VIX already has skew added into it. VXO, which is the original VIX, actually, and a lot of people may not know that, VXO attempts to only use at-the-money volatility. It doesn't do a wonderful job, but it certainly does a better job than VIX, which is more of like an index of vol across a whole host of strikes. So my line of thinking was if I could take VXO and apply the skew index to that, I maybe could get a real vol level for some of that downside. I mean, if you look at the skew index and it's trading 124 relative to what, right? 124 relative to at the money vol of 50 or 124 relative to at the money vol of 15. Big difference in the price of puts, right?
Yeah, I was kind of surprised in the way they constructed it. It almost looked too complicated. If you want the public to embrace a concept, my feeling has always been, no matter what the area, it's the old KISS methodology. You have to keep it
simple, Sebastian, right?
and so to our way of looking at skew, it was always a concept of taking the 90% or the 110 strikes or the 80 and the 120 or so on and applying percentages of at the money to try to look at the steepness. Some people like to just subtract one volatility from the other and talk about absolute value of the differences of the implied volatilities. But to me, it was always a relative type of measure, because what are you talking about with the steepness of skew? It's really looking at an analogy to the slope of a line, and it's a curve, of course, but that steepness would be expressed very nicely in percentage terms. And if you could talk about an at the money and say that a 90 strike was 10% higher or 5 or 12 or whatever the case would be, and then fan that out over different strikes and get different parameters, seems to me that might be an approach that people could understand a little bit more intuitively.
What, you don't think the 115 to 150 inverse type index is very intuitive to the average customer?
I'll try not to make any sarcastic comment.
Well, the issue is that's fine if that's what you want to use for a calculation, but then pick a vol and then, run that calculation off of that vol, and then you have an idea of, hey, here's how it, almost like a VIX or a VXO for the downside curve, not just some number floating against who knows.
Yeah, it's just
right?
an abstract number with very little context. It needs one more step. Yeah, exactly. It needs one more step. It needs another variable multiplied against it or something to make it a little more palatable.
Yeah, when I was on the floor, I used to use a model called the Sabre model, and what it used was a peg volatility, a pump, and a tilt. The tilt was basically how kind of steep the slope was. The pump was kind of the curvature. Well, what they've got here is a curvature and a slope without a peg volatility. So I'm trying to figure out a good way to peg that skew index to a volatility.
This will be an ongoing conversation we'll be having.
Our audience is just fascinated by these abstract discussions on skew.
I'll make a comment, Mark, just kind of joining this late and jumping in off the top of my head, and you've probably given it more thought, but one of the things...
I never give anything thought, Don.
One of the things we used to discuss about the skew was what you talked about, like moving up the curve and the fact as to whether it's stuck or not. And so, suppose you have an at-the-money implied volatility of 20, and you go up to the 110, and let's say that's 18. So the question always became, if the market now goes up that 10%, and when markets rise, volatility usually falls, and you're seeing an 18, has anything really happened to volatility, or is it simply that we're now dropping in at a different part of the skew such that what used to be out of the money is now the at the money?
Right.
The skew stick to it, and therefore your new parameter for at the money becomes that 18. Well, it became apparent to me in trading that, yes, that's exactly what happens in the near term right away. And then people start to lose track of what the absolute level of the index is, and they stop thinking of the at the money in terms of, relative to where we were a while ago, we're really now 10% higher, so, this ought to be an 18, and they forget that, and it wears off. And so they start to now think about, well, this is the at the money. Forget about it's the at the money higher than where we used to be, but it's the at the money right now, and I want to treat at the monies at 20. And so some of that stickiness starts to fade over time, or at least that's the way I used to remember our modeling and discussions of it.
Now, listeners will always ask, why do I tend to disparage VIX cash as some sort of meaningful measure of volatility, and it's these discussions, which is exactly why. There's so much nuance that is behind that number and needs to be read into that when you hear it just spouted, oh, VIX cash is down or the fear index is up 40% this past week or something like that. It really is a meaningless thing.
Well, and I hate using it as a percent. I mean, it's like the VIX is up 10%, except for no, it's not, because the VIX is a percent. So you're basically saying it's a percent of a percent. No, I mean, that's
exactly.
It just is. The one thing I think helps put VIX in, volatility in perspective is think about the absolute. 15% of 1,000 is a lot more than 15% of 500. And, people just kind of think about that when we rally. They can realize that, we're trading 1350 with a VIX of 17. At the end of last year, we were trading 1200 with a VIX of 17. In my eyes, vol is a lot higher right now, And
a totally different beast, 100 odd handles higher. It's a completely different animal.
Exactly.
And of course, this show we do discuss the full spectrum of volatility products here. That also includes OTC and a bunch of interesting swap products, which we'll get to in a few minutes. But there have been some interesting developments on the old realized vol front as well, with some of the vol products coming out over on the CME. I know you guys had some interesting activity on the CME Euro FX vol contract, Don, where you had a pretty significant drop over that first month that it traded.
Well, we did have that initial contract, was the March listing. We spoke about it a little bit last week, which opened in the mid-11s, about 11:55, and by the time the realized volatility was calculated by formula and settled to the expiration value, we were in the mid-7s, about 780 or so. So there was a significant drop, and we spoke about some of the reasons for that, being not only the actual calculation of the volatility itself, but that when the contract opened, you had this risk premium that is built into all volatility products, be they for realized volatility, for the VIX implied volatility, when the futures actually show a premium to the cash, or what might segue into a discussion of over-the-counter products and swaps, where you actually have the same thing there.
Yeah, exactly. And, Mark, you may have missed the earlier shows where we had a lengthy discussion about the transition of the models away from the implied methodology and towards an actual realized methodology, and that accounts for a significant percentage of that drop that we saw in that Euro FX contract. A lot of interesting stuff going on there. I know, actually, you added a market maker out there. Is that correct?
Yes, we did. We have RSJ, which is one of the biggest European market makers, and their presence, we hope, is going to add not only volume, but continue to make the markets just a little bit tighter, the size a little bit bigger. And so, we continue to encourage our listeners and traders out there to take a look at this first listed product, of which we hope there will be many more to come.
And with that, we're going to close out our volatility review for the past week and roll right into the Volatility Viewpoints.
May I have your attention, please? Quiet, please. It's time for the Volatility Viewpoint.
Welcome to the Volatility Viewpoint. This is the section of the show where we sit back and discuss with a guest an interesting topic in the world of volatility. And today's topic dovetails off of the discussion we had last week when we brought Dan on to discuss using delta neutral to capture pure volatility and whether or not that is actually the most efficient way to do so. And, of course, that leads to the discussions of other products that do similar types things, which, of course, leads you inevitably into the OTC vol swap and variance swap market. And this is an enormous marketplace that is not very well explored, not discussed on a regular basis. Most conversations when you're talking about volatility usually comes down to listed products and things like SPX and VIX and other products like that. So getting into the vol and variance swap world is a little bit of uncharted territory for programs like this, but it's very interesting, and I'm sure a lot of our listeners, particularly on the higher end and the institutional end, are interested in a discussion like this. So why don't we start off, before we even dive into the mix, there are a few of our listeners, I'm sure, who are kind of scratching their heads. Let's do a quick basic overview. People who haven't had a stats class in a few years, the difference of vol versus variance.
Sure, and it's interesting to note that when I was on the trading desk a million years ago, they really didn't have these products, and so we used to talk about...
was it only a million years ago? I thought it was 2 million.
Trading volatility.
You and your the head trader, T-Rex.
Good old Tom Rex. I remember him well.
Yep.
We used to joke about, saying I'm long volatility, and I used to say to people, well, you're not really long volatility. You really own a straddle and you're long options, and now you're praying for some volatility because you can't call up the exchange and say, can I have a little volatility, please? It's not for sale. And, of course, the years have changed all of that. And now you can call up and say, I'd like to buy or sell a little volatility, and they have the products. And the over-the-counter version is in the form of what are called swaps. And I always kind of thought that was somewhat of a misnomer in the terminology, because normally when you talk about a swap, you're swapping one return, such as equity, for another, such as interest rate or what have you, and there's the payer and the receiver. But with a variance or a volatility swap, there's only the one product. It's simply volatility or variance, and one side is long and the other side is short, and you start off with a certain number or a strike price, and the payout has to do with how far you stray from that strike price, similar to options, for example. And there's a notional amount and how many dollars per variance point or volatility point. So you're really not swapping anything. You're really just on opposite sides of movement or volatility. Having said that, the over-the-counter market isn't always accessible to everyone. You've got some size constraints because the notional amounts are usually of institutional nature and rather large. And Mark, I think you mentioned last week about the counterparty risk. You're not dealing with an exchange here or an exchange-traded product or the options clearing corporation or those who stand with their full faith and credit, but you're taking counterparty risk from one side to the other.
Yeah, you essentially have the other guy on the other end of the phone, and that's it. So you have to hope he's still there when you want to cash these contracts in.
All of that said, some of the sell-side, institutions are some of our largest investment banks and rather credit-worthy, but nonetheless somewhat different than having an exchange behind a product.
Right.
And so this is the pure way, if you will, of capturing, and yet again, it's interesting to note that you may have VIX products and implied volatility products out there and ETNs, but in the world of over-the-counter volatility and variance swaps, the product, at least to my knowledge, is almost universally realized volatility or actual formula volatility. And again, I mentioned that it's exactly the same formula that we use at the Volatility Exchange during our realized volatility period calculation to get that expiration value. So very quickly, the difference between the two is that mathematically variance is the square of volatility. So if you've got a volatility of 20% or 20, you've got a variance of 20 squared or 400. And as you take a look, for example, at some of the drawbacks of trading the one product or the other, one of the potential problems with variance swaps is because this is a squared number, the actual notional amount and the actual number that you're trading can get rather large rather quickly.
It's a very large and a kind of obscure number you end up getting quoted on these things.
So,
right.
You go from 20 vol to 40 vol, well, you've doubled, and yes, that's a big move, and in absolute terms, it's a move of 20. But if you go from the variances there, you just went from 20 squared, which is 400, to 40 squared, which is 1600. So not double the move, but 4 times the move, everything in exponential fashion. One of the problems with that becomes the margin requirement for trading something like a variance futures contract. And the CBOE actually dabbled and tried to launch that. They didn't have much success, and I'm not terribly surprised because these margin requirements for a single contract very, very quickly can get out of hand, so that if you've got a 25 or a 30 volatility, which would be a 625 or a 900 variance, you might have about a $30,000 margin requirement for just a single contract the way they had constructed it. And God forbid those numbers should double so that you've got now 50 volatility and therefore 2,500 variance. You were looking at, $60,000 margin requirements all the way up the ladder to, the events of 2008 when volatility was checking in the 80 or higher range, and the margin requirements for variance swaps were off the chart in the hundreds of thousands of dollars. So that said, the reason that variance swaps are often preferred by options traders and hedges is because of the ability to actually aggregate or add individual variances and average them, whereas with volatility you have a more sophisticated kind of what's known as a root mean square calculation for averaging volatilities. They're not linear in nature, and it makes it such that when you're trying to replicate the payout of a variance swap, it's somewhat easier to do with plain vanilla options than it is to do the same thing for volatility swaps. Some people believe that it's impossible to do with options, but there are some very fine academic papers by Professor Peter Carr and some of his colleagues where we now know that you can actually replicate the payoff of a volatility swap with plain vanilla options. It's a dynamic process, and I'm not claiming that it's easy to do, but in fact it is possible to do, which was something that wasn't always known and wasn't always available to hedgers.
Now, some people ask us about these types of products. They usually use the terminology of vol swaps, and they might be wondering why we're talking so much about variance swaps right now, when in actuality that's what the market is these days. It is variance swaps. They, depending on the estimates you look at, it's anywhere close to 90% of the OTC vol swap market is variance swaps, and it's precisely for the reasons you listed, Don, that the variance is a little bit more intuitive, it's a little bit easier to unwind because it has that accounts for time in that square root calculation. So if you're looking at an annualized volatility, the variance is much easier to unwind and to trade in and out of than it would be for a vol swap on that same type of contract. So that's why so many of the institutional people tend to lean in the var swap as opposed to the vol swap range. And, when we were doing this show, I decided against my better judgment, I would try to dig around to see if I could find any interesting numbers on notional value. And, of course, you have to take anything you see a notional value in the swap world with a huge grain of salt. I have some interesting stories on that I could get into, but in the interest of time, I won't. But just to make a long story short, whenever you see these numbers thrown around about the notional value of this market and that market, take them with a huge grain of salt. One of the more interesting numbers I did come across actually came from a white paper from our friends over at CTC, which is an options trading firm. I think they were quoting from Risk Magazine, which so take that with a grain of salt as well. But they were saying that on a daily volume in the variance swaps markets works out to be priced in Vega terms about $5 million worth of Vega a day. So, and that obviously that number is a complete estimate in terms of what we're seeing out there. But that gives you some sense of the size of the OTC variance swap markets compared to what you're seeing going up on the listed exchanges. And like I said, Don, too, one of the nice things about the variance products as opposed to the vol swaps, another reason why they are preferred on the institutional side is that they're cumulative. Like you said, the vol swaps are not. And, of course, mentioning the strikes, it does have that square root, so the strike prices get absurd. So that's why the bulk of these products are typically quoted as the square root of the strike. So that works for a couple of reasons. It gives you a smaller number, and also it's actually giving you the pure vol number, which is obviously the square root of the variance. So, therefore, people can intuit that a little bit easier than they can say, oh, I'm trading a 15 vol as opposed to a 225 variance strike. It's a little bit more obtuse. So we see a lot of these things these days quoted or at least bandied about in terms of vol terms as opposed to the pure variance terms. Now, Mr. Sebastian, I know you play around mostly in the listed world. Do you watch the OTC vol swap market at all?
Not as much as I used to, but, when we were in the SPX, when I worked on the SPX trading firm, you had to know that stuff because some huge trade would go on. Most of these happen people imagine that these trading desks are putting these things up, from 9:30 to 4 o'clock. No, a lot of this stuff will go up at 2 in in, some trader in Istanbul was trading against some trader in Liechtenstein, or who's trading against some guy in New York. So we'd come in the morning and find out like some million Vega trade went up in the NASDAQ overnight. And then, you'd know kind of who was looking to do what, because they would literally trade against what they had had done overnight in the listed if the listed was mispriced relative to what had just happened.
My least favorite part of standing out in the S was coming in there and then all of a sudden having some ridiculous 1/5/3 ratio spread come in. That was essentially the guy trying to take the other side and hedge the other side of the OTC swap trade he had done the night before. And he spent a week pricing it out down to the various last decimal point, and you have about 30 seconds in your head as a market maker to do the same analysis.
I know.
on this absurd, complete pick-off paper trade.
They're going to totally run you over. I mean, it's hilarious. I mean, you basically, when I saw trades like that, I would just say, and then I just pretended I had to go to the bathroom. So,
the brokers love that when you vanish.
I know. No, we had this.
Good luck getting the juicy combos after that.
Sell Vega on a busy day, he'd go hide. He'd literally hide. No, but. It's important to kind of know what type of stuff was going on so that when some guy came in looking to do that stuff, you know that he's got to price it down. Our advantage was that we knew what he was trying to do, and so we would try and pull a little bit out of it and hopefully be able to aggregate the rest of our position against that stuff.
Yeah, exactly.
But in the future, I'm going to try and pull in going forward, I'm going to keep my feelers out. I'm going to start tapping into my OTC contacts to hopefully bring some variance and volatility swaps that maybe go up on the OTC market to you guys.
Yeah, because that sort of thing obviously directly impacts the listed, and when we see big trades going up in the listed, without the other side of that, you're missing some of the context of what it actually is going up there. It'd be like trading the SPX without watching the big future options pit in the CME. You can't have one without the other.
Right.
They are linked, and same thing with the OTC, and you don't really hear as much about that. Now, Don, I know you wanted to get into a little bit more about the linear nature of the payoffs versus the nonlinear ones, some of the other variance swaps. So why don't we dive into that a little bit?
Well, the point that I was going to make, and it does make the connection rather nicely, is that with the VolContracts that we're now beginning to list, and again, hopefully will be out on many of the major indices and more popularly traded underlying assets, we really have brought the notion of a volatility swap with a linear payout to a listed contract, and a contract, again, with 1,000 multiplier, so that the notional for 20 volatility would be 20,000, and therefore perhaps more in line with the possibility of retail trading as opposed to the huge institutional sizes. And so you have this concept of the linear nature of the payout of a volatility swap. If you start at 20 and vol goes down 10 points as opposed to vol going up 10 points, you have the same magnitude of a 10-point differential. As soon as you translate that into variance terms, you understand that there's curvature. There's what we call convexity, because a 20 volatility is a 400 variance. If you drop 10 points in volatility to 10, well, that's 10 squared, or 100. So you've just gone from 400 to 100, and you've basically dropped 300 variance points. But if volatility goes up to 30, and you square that to get 900, you haven't dropped 300 points. You've gone up 300. You've gone up 500 points from 400 to 900. So there's a curved payout. What that means is that for exactly the same up move as opposed to a down move, you make more to the upside with variance than you lose. And you've got to adjust for that concept in some way when you create the strike price. So what typically happens with variance swaps is that the initial strike price is different from that of a vol swap on exactly the same instrument. Vol swaps tend to be struck very much in line with the current at-the-money implied volatility of the options on the underlying, whereas variance swaps tend to be struck more along the lines of about the 90% options, which, if you look at the equity skew at least, means that that's a higher number because you're below the market. And again, the reason for that is to try to equalize the payout if you happen to have a similar up move and a similar down move, so that rather than having the linear symmetrical payout of a vol contract, this is an asymmetrical payout with a variance swap, and that adjustment is inherent in the initial pricing.
Now, Don, I know when you were slinging the size back on the trading desk, there were no listed volatility products that you could trade, so your only choice really was the variance and vol swap markets. Were you pretty active in those in the OTC?
Actually, we did listed options, and so we didn't even have the variance swaps. They were in their infancy. They were more theoretical than actually products that we're trading. These were in the mid-1980s, for example. I can remember papers first being written about them. And so most of our trading in order to capture volatility or time premium was done with options themselves. And then, of course, swaps became an extremely big product. And now I'm hoping that we're going to, in some ways, come full circle with our listed product as a complement to the VIX, for people who really do want to trade the actual or asset or realized volatility, but aren't as comfortable going to the over-the-counter market. So again, the innovation, if you will, of the volatility exchange will be to get the notion or the concept of something like a volatility swap, but onto a transparent listed exchange product where people can actually see the development of the volatility from day to day, follow the formula, take a look at our website where we have all of these numbers listed, and get a feeling for what the actual volatility of the underlying asset is displaying.
I'm looking forward to trading a forward volatility on an actual volatility. Once, I'm guessing the next step here is going to be options at some point, Mark, don't you think? So then we'll be trading implied volatility of a forward volatility on realized volatility. What do you think about that?
I like it. The VolX option, or the vol option, I guess you can call it then, as a vol future or vol contract.
We see that in the cards. It's inevitable that if you start with an underlying asset and that asset has options and then it has some derivative product on it, such as VIX futures or let's take our volatility contracts, that the next move logically is now to create options on that derivative product. So of course you've got implied volatility options on VIX. And once we get up and running with some decent volume and an array of underlying assets, I have no doubt whatsoever that it's in the cards somewhere down the line that we will spawn options on the vol contracts and therefore have realized volatility options along with the VIX variety.
So let me ask you then, can the VolX systems, can they even wrap their heads around an implied vol, or where the whole thing just explode the second you try to run an implied vol, because realized vol is so ingrained in your DNA over there? I expect the second you try to run implied vol through options on VolX, the whole mechanism will just implode from...
It's like crossing the streams in
exactly.
Ghostbusters,
It
right?
will refuse to do it. It will say, no, I will not generate an implied vol, and it will just shut down.
Well, that's a really interesting point that you bring up, and I'm going to show you that we're broad-minded enough to have actually thought of the concept even as we look at our vol contracts, because I think
Don, I have to say, Mark and I are both broad-minded, maybe in a little different way than you are, than VolX people, but we're broad-minded.
I actually pointed our listeners to the spot of the VolX.us website where we have our VolX series, and that would be the actual calculation of the current volatility of a product. We've got the April 1-month volatility up there now for the euro. We've got the June 3-month, because that's April, May, and June, so it has started its calculation period. And what you'll see there is the partial volatility, namely any actual volatility that has been logged by formula because the clock is ticking, so to speak. But then you'll have a notion that we're referring to, just to differentiate it from options. We're calling it IVOL, and we're calling it inferred volatility. And that kind of speaks a little bit to this root mean square formula that we were talking about a moment ago. So let's say that you're a certain number of days into the calculation period and you've calculated the partial volatility up to that point by formula. Nonetheless, the contract may be trading at a different price, simply because there's still a number of days left to the expiration, and there's a forecasting mechanism, and that forecasting mechanism may very well be along the lines of the implied volatilities of the at-the-money options in the underlying asset for the number of days remaining. And so what you get is a combination of actual or realized volatility and this stub that's left to expiration, which very well may be forecast volatility. And so what you do is, when you look at the price of the contract and you already know the piece of the logged volatility or the realized, you can back out that what we're calling inferred volatility. You can infer from the price of the contract what volatility is being used to price the stub or the remaining days. So what we think is interesting about VolContracts is they kind of give you the best of both worlds. You've got the realized volatility component, but you've got an inferred or an implied volatility aspect to the pricing as well. And so you've got VIX-like types of parameters that are being applied, but you do still have that overriding actual volatility calculation, which is something that you can't get with a VIX product.
I like that, Don. I like that. Inferred vol. It's a nice little end around, of course, or iVol even. Of course, you have to watch out whenever you slap I in front of anything. The Apple trademark lawyer is going to come sniffing around you very quickly. Not to mention the guys over at iVolatility who might also take issue with that.
Yeah, I wouldn't go with we have a vol product for that as your catchphrase if you're going to use iVol.
Right. Well, we've got a couple of good patent attorneys, and I know that we've got trademarks and patent pending for most of this terminology. So I'll leave that to the lawyers, and we'll sort all of that out.
I like it. It's kind of, that's the legalese way of letting God sort them out, right?
There you go.
Well, listeners, we just wanted to take you on the next step of our discussion from last week, which was, of course, the challenges of using delta neutral to capture vol, and open up to a brief overview of another way to do that, which is, of course, using the volatility and variance swaps as well as the VolContracts to do the exact same thing. And obviously, this is a very, very elaborate topic that we could devote multiple episodes to, just the mechanics and structure of the OTC vol and variance swap markets. But we wanted to give you kind of the quick hits, how they're priced, how they work, some of the fundamentals of them, so you are a little bit more familiar with them. And with that, we're going to roll right into our crystal ball segment.
And now we take a look at the crystal ball.
Welcome to the Crystal Ball. This is the section where, like I said earlier in the show, Don likes to speculate wildly, and it's my job to rein him in. And I brought Mark Sebastian on to assist me with that, but of course, Mark likes to speculate even more wildly. So between the two of them, we should have some wild and woolly speculation. So by all means, Sebastian, since you are the quote-unquote guest, I will allow you to go first and give us what you're looking at in terms of volatility for the coming week and what you're thinking is going to happen in terms of, skew and implied out there.
Well, I've been kind of keeping my eye on S&P 500 skew. It's a pretty flat. Now the skew index isn't, but if you look at, month to month, right now S&P vol pretty flat, and I think volatility as a whole is kind of sitting near some sort of bottom. I don't see how we're getting a lot lower from here. We may not explode higher, but I certainly don't think we're going a lot lower. Things I've been looking at is ratio spreads. If and when they have realized vol contracts in the S&P 500, I'm on something. Let's say, I wish there was an exchange that maybe would list something like that. If there was, this would be the time where I might be interested in purchasing a contract like that. So I think that realized vol is probably going to be ticking up. I think implied vol is going to be ticking up. I think that skew is going to be ticking up. Next week, not a lot of economic news, but I think, who knows? We could get plenty of world news. What we're having lately is what I like to call your big brother jumping out of the closet events. Okay? And if you're wondering what that means, there's a big difference between, the fear we went through in like 2008 and during the flash crash was kind of like, I'm going in to have dental surgery. Like, we know it's going to hurt. We're just not sure how much, and we're scared of it. Okay? What we saw kind of during the Libya stuff and during Japan was more like your older brother jumping out of the closet. He goes, boo! And you're scared for a second. Once you realize it's your older brother and not a knife-wielding maniac, you calm down pretty fast. So, I think
so as opposed to Michael Myers events, these are the big brother jumping out of the closet.
Yeah, exactly. You like that? The big brother. I mean, my brother's been jumping out of the closet for years.
I guess there are worse things to jump out of the closet than your big brother.
Exactly.
Depending on the nature of your big brother, I suppose.
Right. So I think we're due for another big brother jumping out of the closet event.
Like, is that going to be on the next thing up on the optionpit.com? Big brother jumping out of the closet index.
That's going to be my next thing.
Next
big
venture.
brother event likelihood. The communists are going to not like that.
Of course, always when I hear analyses such as this, I always kind of revert back to the tail wagging the dog and which comes first. And I don't have any qualms at all with Mark predicting that levels of volatility, which now in equity, for example, are in the 16 range or so, and probably as actual or realized volatility even a drop lower, to saying that they are likely to rise. But along with that, I would point out that if they do rise, it's not going to be because they're low and therefore they have to go higher regardless of what the market does. It's going to be because the market is going to drop, and in reaction to that, volatility is going to increase. So with this tremendously strong negative correlation between equity price movement and either realized or implied volatility movement, I always believe that when somebody says, well, volatility is low and it's going to go up from here, that's tantamount to saying I'm predicting that the market is going to drop, possibly precipitously or not, but that the market's going to drop. Because one thing I would be willing to bet is that if the market continues to rise over next week or the next few days, that in fact you won't see volatility rise, because it's just very unusual to see the market go up and to see volatility go up along with it. So it'd just be interesting to...
It does happen.
It does
point out that it does happen.
It does happen. That's why the correlation is negative 80% and not negative 100%, because there's no law that says that it has to happen. But it would just be interesting that when you do make a prediction for increasing volatility, my question would always be, and what's your view on what the market is going to do?
When I say when I say I think vol is going to maybe rise, I typically think straddle. I don't think put. Now, when I see something like we have now where implied vol skew is low along with lower implied volatility, what I'll do is do ratio spreads, which will overweight the skew. But I never like to just say vol's low, buy puts. I don't buy that. I don't buy into that for a second. Because you can be right and wrong at the same time in that scenario. I prefer to just be right, which is what I'm known for, Don. I don't know if you knew that. I don't know if Mark prefaced you, but
Mark,
they call
greasy
me Mark,
meatball, right, Sebastian.
Yep, Mark.
More for his
right
political
meatball,
leanings than anything
yeah.
else. And Don, that greasy meatball is a nickname he earned on our other show, and I won't bore you with the details or perhaps discuss you with the details of how he earned that nickname. But
Okay, you'll tell me another time.
and of course, right, because he is a heavy investor in the Ronald Reagan Presidential Library. Don, I like this discussion, and I think we should get into this some more because I think this is interesting because it gets into some of, I think, your core beliefs in terms of volatility and your viewpoints and where you're coming from a trading and as opposed to some of the other people we have on the show. And I think this makes for a nice, lively discussion about, because I know there's multiple frames of reference that people approach the options market now. I know when I first walked onto the floor of the SIBO, all the guys I knew who had been there for some time, they took the viewpoint that options are insurance and you make money selling insurance, not buying insurance. And so the notion of buying contracts was almost anathema to them. And the other old slogan was when in doubt, palms out. And, that was a very prevalent mindset and still is today in many traders. And of course, we also see a lot of the high end of the retail spectrum who lean towards premium selling as well and very are hesitant to buy. So I think this gets into the conversation of, discussing vol in terms of quote unquote low, in terms of cheap and what that really means. I think this could be an interesting entire episode discussion perhaps for next week. We'll get into that. What we mean when we say vol is actually low or vol could be cheap. It might be a good time to jump in and hedge and what the ramifications of that are down the road. I think there could be some good back and forth on that. What do you say, Don?
That would be great. I traded volatility for a little bit more than 10 years on the Morgan Stanley trading desk, and I can actually remember buying an option. I think it was around March of 1992 or so.
Nice.
So I've actually bought an option once or twice during those 10 years.
Do you have the certificate framed on your wall somewhere? The one lot that I bought just to say I buy vol?
So we'll get into that and to my famous slogan that people used to kid me about, where I would say there's really only two things you ever ought to do with an option, either sell it or don't sell it. And so the end of 1994, when realized volatility in the S&P was about 4.9 or so, you probably didn't see me selling a lot of volatility, but it didn't mean that I was jumping in wildly and buying everything that you could either, because those markets were so dead in the water that it actually was possible to buy and still see the options decay with no movement in the underlying whatsoever. So those were times when typically I was sitting on the sidelines doing nothing and not selling as opposed to buying.
Don, I've heard sell the preem, live the dream. I've never heard don't sell anything and buy a house in Arizona. That's a new one to me, but that's what it sounds like you're pitching.
There you go.
Yeah. I think, like I said, I think there's a lot of grist for the mill in that. So I think we have our topic for next week, Don. I think we can get into it.
Grist for the mill. That's a little old timey. You going down? Were you just down? Did you just take your kid down to Salem, Illinois?
We have to cater to all of our demographics there, Sebastian, not just the tweens that you like to speak to on a regular basis. We have a full range of audience members out there. And some of them remember the old mills, and they like the references every now and then. When you sit in the big host chair, you have to think of these kind of things.
Understood.
But yeah, Don, I think that's interesting stuff. We can get into some of the benefits of when it is worthwhile to buy premium for hedging and other aspects like that, and onto ratios or, the pros and cons of trading straddles. I'm thinking it already of all the different things we could get into next week. So I'm getting pretty excited. So I think with that tease, we will close out this episode. I want to thank our guest for this week, Mark, the roving volatility pit reporter Sebastian, for coming on the show. Hopefully we'll have to make it a regular. You can come on for the review and the crystal ball segments at the very least, Mark.
That'd be great. I'd be happy here. The roving report, that's like the nicest nickname you've ever called me.
I think it is. I'm trying to take a new tone with Don. I try not to go in the gutter as much as you guys drag me into over on the option block. Don's a much more involved person, so I need to
higher level here.
Yeah, exactly. I need to raise my game to his level a little bit, and no more mini metals jokes on the Volatility Views show. And of course, my partner in crime, the yin to my yang, if you will, good old Don Schlesinger from VolX. Don, thank you for joining me as well.
Thank you. My pleasure. I'd like to just thank the listeners for starting to contribute to the Volatility Views forum that's on the Options Insider. We've gotten a few questions already. I try very hard to respond immediately. So keep those cards and letters coming, and keep posting. We'll try to answer all of your questions.
Oh, by the way, I can't close out the show with allowing each of you at least to plug your respective sites. So Mark, why don't you go first? Give us a little bit of hit what's going on at optionpit.com right now. Mark, today we're recording this on a Friday. It's our 1-year anniversary of being officially incorporated today.
Congratulations.
Congratulations, sir. You are now in the big time.
Thank you very much. I actually just wrote a really interesting blog at optionpit.com that went up 2 days ago that I think is worth a read. And, actually, I've had several in a row that are just dynamite blog entries that I would encourage people to read. The one I think is interesting, though, is the one from Wednesday where I discuss whether the VIX is becoming a bit of a dinosaur with the advent of weekly option. That would be a good read. And then make sure you check out our events tab for all the latest going-ons at Option Pit. We do free webinars every month, so come on and check us out. Yeah, the short dated options and how they impact volatility is another good topic we could get into down the road as well. Maybe we could discuss any plans VolX has, and if we're diving into the short dated frenzy that's going on right now, maybe we'll see weekly VolContracts or something fun like that. Don, of course, give our listeners how they can learn more about VolX. Give us the old URL for our listeners who want to learn more about VolContracts.
The website is VolX, VOLX.us, and again, there is a wealth of information, including all of the current quotes of realized volatility, looking backwards historically, looking forward at forecast volatilities, an entire reference library filled with academic and scholarly papers on volatility, and a lot of discussion about the topic and description of the product line. So take a look at the website. We think you'll enjoy it.
And, of course, as Don alluded to, we want to encourage you to continue posting your questions and comments in the forum. Just surf on over to theoptionsinsider.com/forum. Scroll on down to the Volatility Views section and post your comments there if you want to leave some nasty comments for Mark Sebastian. Then, of course, do that in the Option Block forum. And if you want to leave us some voicemails, by all means, drop us a line at 312-544-9356. That is the Options Insider Radio Network line, and you could leave a voicemail for all of our shows there. Just dial us up. If it's interesting and exciting and pithy, we shall play it on the air and immortalize you for all of your friends and neighbors. And with that, we'll close out this episode of Volatility Views, and we'll see you next week.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the VolX Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.